Fires in LA. Let's talk about it on Today in Mortgages. Hey, what's up, Dreammakers? Welcome back to the show. We're talking about what's real, what's hype, and what you should actually be paying attention to out there in the world of mortgage and real estate news. Rich, hey, it's been a while since we talked. Welcome back to the show. How are you doing?
I'm doing great, Michael.
Hey, we had a good break, a long break, and then we were traveling some. We had to take care of some business, and then I understand that you dropped your daughter off at a study abroad program, so you were abroad for a few weeks, and then you're back. I was hoping that we would have just like tons of good news to talk about today, but Rich, it's really unavoidable when you're talking about homes in the United States right now to miss the big story, which is these fires out in Los Angeles in the Palisades and the Eden Fire. And it's been really insane to watch. Rich, you've been watching this?
Yeah, that's my hometown, so I follow it close. I mean, you look at the Malibu Strand right on the ocean. That's a summer holiday, getaway for my family for the last 15 years. So many of those homes we have rented for a week in the summer, and they're gone. It's just incredible.
Yeah, it's been truly incredible to see and really horrifying to understand the consequences that will come after the fact. I mean, the fire's still burning, things are still happening on the ground there, but people are already looking to the future. And Rush, we pulled an article today just to kind of talk through this, but we'll talk a little bit about some other stuff as well. Reuters had an article, the title of which is Biggest U.S. Banks Ready Mortgage Relief for Victims of Los Angeles Wildfire. Rich, this article talks a little bit about some things that individual banks are doing to help, maybe some donations, but it also talks about forbearance. And that's kind of what I will focus on today. I'm here in Houston, and so we have some of this experience when it comes to hurricanes. Also, everyone out there probably understands forbearance a little bit because of COVID. But when it comes to natural disasters like this, Rich, what is the response from banks, mortgage service providers, and what does forbearance mean for these people?
Yeah, well, forbearance just gives you a break on the payments. So for example, if your loan is a conventional loan, owned by Fannie or Freddie Mac, then, you can get forbearance in those kind of situations for up to 6 months, and then you can reapply for extensions to give the break. Now, you skip the payments are not forgiven. They're just pushed to the end of the term. You end up paying them later. But those, reach out to your servicer and talk to them. If you're in a situation like that, there are options for you for conventional loans. Now, clearly, the ones on the coast, Michael, those folks are probably not needing forbearance because those are multi-million dollar homes. But not every home is multi-million. There are some just over the conventional loan limits, which are considered a jumbo loan. And every single one of those investors operates forbearance differently. So they should reach out right away. But the one thing about California is they have a homeowner's protection where the servicer, whoever owns a loan, has to reach out, before any kind of foreclosure proceedings to try to work something out, one of which is forbearance. So, they'll be taken care of.
Rich, there's so many complications, and even what you just mentioned, they have to reach out, that has to happen by mail, and they don't have a current location. So people are going to have to be communicating with their servicers to understand how they can gotten a hold of, and understand where that mail is being forwarded, and all the things that come along with that. Rich, one of the big concerns that we're hearing in the news right now, and this is just awful, is that a lot of these people had their fire insurance canceled months or years ago because of the high risk that's happening on the ground all the time in California. And there's just not going to be an easy path forward for them to rebuild. What are you hearing about that? And what do you think the consequences of that are going to be?
It's tragic. It's really tragic because some of those homes, like in the Pacific Palisades, like those are higher end homes. They're very expensive homes, but not everybody that lives in there, it has $1 million mortgage. So a lot of those homes were inherited, and they were given to their children or, so some of those are free and clear. And, many carriers pulled out of California in the last couple of years, State Farm being one of the big ones. And many of those homes are not to the standards that, insurance companies need them to be in order to be insured. So unfortunately, there's quite a few homes that were uninsured after those carriers pulled out because they just couldn't find a homeowner's insurance company to take them. So
Right.
that'll be, you're really talking about they're going to have to sell the land and move somewhere else.
Yeah, it's really terrible, Rich. And why I asked that is because I kind of want to look forward to something that maybe is a little bit more pertinent to us. And that is whenever the recovery starts happening and mortgage providers are starting to decide whether they want to provide mortgages in this area and what the risks are there, how is that going to play out? Is there risk of that? If it's a risk of mortgage providers saying, you know what, we're just not going to lend in these areas anymore because it's too risky.
Well, you can. Yeah, they can decide not to lend in the state. You can't just say I'm not going to lend in that area. That would be considered, redlining and all of that stuff, which is prohibited in our business. You can decide not to lend in California and just forego your lending license in California. That is an option for a company, but that's not realistic. I mean, California, it's like 20% of the mortgage market. So, mortgage companies are not going to pull out of there. They're going to find a way to make it happen for their clients.
That's good news. Will there be any sort of additional cost that could be tacked onto that? How can mortgage providers protect themselves? Is that something that they could do, or is that really not an option?
Well, listen, there are certain pockets, rates are, let's say the rate is 7%, national average rate. Well, there are certain pockets where the rate is a little bit higher because there's risk assessed into there, risk for either wildfires, risk for, lots of things. It could be lower loan amounts, could be higher loan amounts. I mean, lenders decide where the risk is and they price accordingly if they're lending in those markets. So, lenders always find a way. Lenders want to lend money. That's it. And the safest place to do it is, lending towards home ownership. So it's going to keep happening. That's a giant market. It's going to be super hard for those people because you talk about they're going to rebuild. I mean, a lot of people are just going to rebuild. They've been in Southern California their entire lives, their whole families there. They're going to rebuild. It's just the process is going to take at least a year just to get permits and everything to rebuild there. So it's a long-term process.
Yeah, some are saying that a year might be optimistic, Rich. And so, our thoughts and prayers definitely go out to everyone that's been affected by these fires. It's an ongoing situation, it's terrible, and we want to continue to think through how these things affect the industry. Hey, Rich, before I ask you some questions about some other current events that's happening in the economy, I want to just remind everyone out there that we are part of the best network in mortgages, network funding. And if you're interested in starting 2025 off in the right direction, click the grow link below. We'll get you all the information you need to know about joining the best network in mortgage and how we can help you grow in 2025. Rich, I want to talk a little bit about some news that's come out just today. We got the PPI report, and I don't want to glaze over that because it's important. What happened with that, and will it have consequences for our kind of trajectory going into the new year?
Who knows, Michael? I mean, it came in softer than expected. So that's good. Like the inflation component of the PPI piece was lower than expected. So that's good news. And that's the producer price index. So that's like the wholesale.
Mm-hmm.
Like you and I, if we sell a widget, it wasn't as expensive as the analysts thought it was going to be to like restock our shelves to sell it to, a retail outlet. So that's kind of what that is. So it was lower, but tomorrow's the big report, which is the CPI report, which is what we pay in the field, um, in the market rather. And so that one will have a bigger effect. Like it really didn't affect the markets that much today, the PPI, but tomorrow will be a little bit different.
We had a hot jobs report last Friday, the PPI report today, and the CPI report, like you said, Rich, coming out tomorrow. So we'll still continue to pay attention to those things. But, Rich, if we learned one thing in 2024, all of that is good and well, but the Fed is going to do what the Fed's going to do, and the economy is going to go in the way the economy is going to go. And so we'll continue to pay attention to it, of course, and we'll talk about when it's important. But, Rich, the thing I think we're more concerned about, at least here at the network, is how we are facing the headwinds head on and making sure that we're preparing our people to fight those good fights. So, Rich, anything you want to say about us moving into 2025 before we sign off?
Yeah, no, I mean, we're really just focused on making sure that our potential clients know every single loan product available to them to help them get into homes today. Because right now, inventories are up. And it in almost all marketplaces, inventories keep climbing. So there's more homes for sale, more opportunity for home buyers. And the home buyer right now has the upper hand. They're able to get concessions and things to help with buying down interest rates. There's lots of opportunity for a buyer. If you're a buyer that qualifies at a 7 or a 7.25 interest rate that we have today, make your move. Home prices are still anticipated to grow over 5% this year. If rates come down, it's going to be even worse and more competitive to buy a home because more buyers will be in the market. But if you can make the move, if you qualify at the interest rates today, the purchase price is the most permanent thing in this transaction, not the interest rate. You can always refinance the interest rate when rates come down, but make your move today.
Rich, good word. I think we'll leave it there. It's so good to have you back on the podcast. And thank you to everyone out there watching and listening wherever you are. We appreciate you. Happy New Year, and we'll catch you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates, and any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.